I want to thank everybody for coming this afternoon, for joining us. My name is Lazarus. For those of you that are not familiar with me, maybe some of you have attended some other webinars I've done in the past, or even participated with me on our virtual trading floor, or even better, in the Active Trader program, which is something I've built a few years back, and it's been a labor of love and something I care very deeply about. So today's webinar, we are going to talk about the student becoming the teacher, and we are going to talk a little bit about my story, how I got to where I am, and we are going to introduce you to Rich Annunziata, and Rich is going to be taking over the reins of the Active Trader program. We're going to talk a little bit about the Active Trader program and show you some good technicals and some good strategies as well. So let's get through it here. We have the disclosures, and that's not the fun stuff. Myself, I am the CEO of T3 Live now. I've been a trader for what seems like forever, although it's only been 15 years. 15 years as a trader is basically forever. I've been a mentor, an educator, a teacher, as well as a trader for a long time. I'm going to hand it over to Rich, let him talk a little bit about himself, do a little intro. Richie?
Okay, everyone. I'm glad to be here today. Laz, thank you for the kind words. So probably like a lot of you out there, I got interested in trading because first I wanted to make money. You know, I love the freedom. I love the flexibility. You can make your own hours and just the thrill of being in charge of my own destiny and making as much money as possible. But quickly did I learn, you know, without a plan, without really getting the education and taking the time to learn and study, which is always an ongoing process, the market will drain your bank account, will drain your oomph. It will beat you down. And the moment you let off and you stop learning and you don't give it your all, the market does take the money from you. It takes the endurance, any type of discipline. It just could beat you down in all aspects. So, you know, I found myself, you know, maybe a lot of you are in similar situations now. When before I began the program, I really did not know what I was doing, and my approach to the market was just totally off and misleading. It's not. There's no easy money out here. There's no free lunches. So without the right education, it really is a dangerous place to play in. And if you treat it like a hobby, it will pay you like a hobby. If you treat it like a business, it will pay you like a business. So it's really important to get the right education, and I can't stress that enough. That's when I turned the corner personally. So.
All right. You mind if I step back in, Rich?
Sure. It's all you, baby.
All right. So we're going to talk a little bit about some important stuff. And for those that have, like I said, for those that have worked with me in the past or even attended any of my previous webinars, I am a huge believer in trading is not just about up or down or candlesticks or moving averages or technicals. That's probably 20% of what we do. The other 80% is what goes on in between your ears. And this is a business, trading is a business of thought. And you have to think about what you are going to do. You have to plan. You have to be prepared. You have to work to be successful in this business. And we've, you know, I've one of the keys that we're going to talk about, but the overall theme here is always going to be simplicity. So we've mapped out, Richie and I, or you know, I've mapped out 5 keys to what I think ultimately are big factors in determining somebody's success. So success is basically 5 principles that are the core, or you know, the core of when we set out to build the Active Trader program. These were the core principles. And when Richie came to me, which seems like forever ago.
Many moons.
How long ago was it?
Many moons.
Many moons. He wanted to do this trade. He wanted to do that trade. He wanted to be long. And he wanted to be short. He wanted to swing trade. He wanted to day trade. He wanted to do everything. And he was, you know, he had great energy, but he had no focus. And we spent months reinforcing that you have to be good at one thing before you can do 5, 6, or 10 things. Jack of all trades, master of none in trading is a big, big mistake. And I know a lot of traders hop from strategy to strategy, you know, thing to thing to thing, time frame to time frame, never really finding something that they ultimately can call their own. and they spend time working at that one thing. With Rich, as an example, and I'm not to throw him under the bus, because this is a story of trader, lost trader, found trader. And when we started working, he had pretty much the same habits that most traders that come through my doors or the active trader doors have. He was impulsive. He was making trades based on how he felt in a given moment. He was making trades based on an emotion, whether it was an emotion that he felt, because the market was going up, or because the market was going down, or because he was pissed off, or because he was happy. The rationale was not the right rationale for buying and selling stocks. So the first thing we did was we talked about, and we really started to drill down on daily charts. Now with daily charts are a really good snapshot of what's happening overall in a stock, a security, or even an index or a general market. But when we look at daily charts, we're not just looking at whether, when we read them from left to right, whether they're going, ascending and going up in price, or descending and going down in price. That's kind of a novice approach. We're looking at, the 21 EMA. We're looking for how that determines a trend, whether it's rising, whether it's declining, where it is in relation to the 200 EMA, tells us whether the stock is very bullish, moderately bearish, or very bearish. So we look for detail above and beyond what most novice traders or uneducated traders, come in looking for. So you put yourself in a position of finding the right securities or the right trade opportunities and positioning your brain to think about what potentially you could or should do next. We know, based on reading daily charts, types of trades you want to stay away from. What is easy money? What is hard money? Just by looking at a simple daily chart and looking at it with the right parameters, you should be able to narrow your focus to be able to say, okay, this is a chart that I want to look to be long, and it has a very bullish scenario. This is a chart that I want to look to stay away from because it is without a trend. It is hard money. So just by doing that, you're putting yourself, again, it's a business of probabilities. You're increasing your probabilities dramatically by understanding how to read the language of the daily chart. The low-hanging fruit. So reading intraday charts, as I said, is learning how to find the low-hanging fruit. And once you have found that the symbol or a basket of symbols from which you feel comfortable trading, whether it's to the long side, to the short side, we then look to apply strategies on how to actually make execution, how to buy, how to sell, where to buy, where to sell, and why. And for those who have, like I said, have worked with me in the past or listened to me teach, why? It is so important that you ask yourself that question. It's something that Rich and I spent so much time talking about. And he would say, Laz, he would come to me and he'd say, Laz, I like this trade. I like Goldman Sachs today. I'd say, why, Rich? And he would have to give me 3 reasons. He'd have to start from the daily chart, and he'd have to funnel it down until he could actually verbally tell me where the trade was, on what time frame, and why. So we worked on strategies, how to implement a few basic execution strategies. By doing that, we created an edge. We found, or Rich found, his edge. Now, over time, it wasn't a series of days, it was a series of months. And it was time spent learning, time spent practicing, time spent journaling, time spent working on doing the things that prevented him from achieving what he ultimately wanted to achieve that very first day. He didn't have the right mental, sort of capacity. He didn't really know what his edge was. He didn't know how to find the edge. So he had no foundation. So what we did was we basically built a foundation for himself, a foundation that he now uses every single day, and it's a wash, rinse, and repeat cycle. So part of the program and part of the principles here is finding that edge. So we want to combine the interpretation of using daily charts to find good strategic symbols to trade, as well as using intraday or smaller time frames to find execution spots where we believe we have the best chance of getting a reaction and then looking to take advantage of stocks that are either rising or begin to decline. We call this time frame alignment and time frame analysis, and it is a massive part of what we do in the Active Trader program. We are evaluating what the story of the stock is on various time frames to determine when the edge is in our favor or when the edge is not in our favor. And I tell the story, and I think it paints a very clear picture that what we do is, like I said, it is a business of probabilities. Being a good trader is finding high probability situations and exploiting those high probability situations. Being a successful trader is not about being right. Most traders think they have to be right. You don't have to be right. You have to find high probability trades and exploit, like I said, those high probability trades. So the story that I always tell that I think is very, very poignant here is when you play blackjack. And again, I don't generally think that trading is gambling or anything like gambling, but when you play blackjack, what most do is they sit and they bet every single hand. For those that are familiar with the game, you put money in the little circle, the dealer gives you the cards, and hopefully you get to closer to 21 than the dealer. And it's a game built upon hoping, wishing, and praying. Yes, you can count cards, and yes, you can find subtle ways to maybe increase your probabilities by 1%, if you can even do that. But most of the time, you're going to lose because you don't really have any reason or rationale for evaluating the risk. But if the game was played like this, the dealer puts both your cards in front of you, and then the dealer has one card showing. So, for example, the dealer puts 2 10s down, and you have a 20, and the dealer is showing a 6. And the dealer says to you, "Sir, ma'am, would you like to bet this hand?" Well, you're going to say to yourself, I have a 20, the dealer has a 6. There is a very high probability that this is a hand I will win. Now, it doesn't mean the dealer can't get 21. There is a chance you will lose, but statistically it is a much smaller chance. So when I ask the question in the room, every single student says the same thing. Oh, I bet that hand. I take all the money in my wallet and I put it in the hand. I take all my chips and I put it on. And that's the way the game needs to be played. That's because you have calculated edge. You have probability. If the situation were reversed and the dealer's showing an ace and you have a 12, you have 2 6s, chances are when the dealer says, "Sir, ma'am, would you like to bet this hand?" you are going to say, "No, I'm not going to bet this hand." Why? Because the probability is not in your favor. You don't have the same edge. That is trading. So the business of trading is being able to understand and calculate when you have that edge. That is what we do for a living. That is what we teach. That is what we live by. That is how successful traders become successful traders. Their mind begins to think in terms of probabilities and risk. And even when you get that beautiful setup, it doesn't mean that it has to work. Beautiful trades that are high probability situations can still fail. You can still have a 20 against a 6 and still lose the hand. So it's about understanding when the balance of power is in your favor. So finding an edge means you become proficient at waiting for your pitch, waiting for your trade to set up, line up, the time frames are aligned. The strategy is very much apparent on the time frame from which you're looking for. So what we've done here, at least with Rich as an example, is we've increased his win rate, which in turn increases his conviction. He now believes in his ability. And when you have that, in turn, over time, your profitability exponentially increases. It is a very healthy, good, positive cycle. It takes time, and it takes a willingness to learn, but it can be done. You have to focus on the process. And again, I believe in this wholeheartedly. Most traders that seek education are so focused on the results. I want to make money. I want to make money. I want to make money. They never take the time to focus on the process. And the funny thing about it is that if you are a trader without a process, you will never get a result. Traders without a process do not get results. You might get a result today by getting lucky, or even this week or this month, but there will not be a long-term strategy of consistency and success year over year irregardless of the market, bull market, bear market, trendless market, you will find ways to make sure you are going after high probability situations. So principle number 4 is discipline. So discipline is a term, gets thrown around everywhere. Books, magazines, websites, blogs, discipline. You got to be disciplined to be a trader. Discipline. But when I teach, it's one of these terms that I think is really just not understood. When people talk about discipline, they talk about the first thing, well, I don't want to lose a lot of money. I don't ever lose a lot of money, Laz, so I'm disciplined. Well, that to me is not necessarily discipline. Discipline is knowing what you're good at. Discipline is focusing on the things that you become proficient in. So you are not trading as a result of boredom. I know the trades that Richie has become proficient in. Richie focuses on those types of situations. When he doesn't find those situations, he doesn't do anything. And the hardest part of being disciplined is the ability to do nothing. And for those that are more in the day trading arena, the ability to do nothing is a very, very hard thing to do. I've met with hundreds of, even thousands of, students at this point in my career. The ability to sit in front of a screen, watch your charts, your stocks, and not actually have on a trade or not want to make a trade is a very, very difficult thing to do. But I think if you learn how to do that, there's real growth there. It means you are forcing yourself to do what is not natural. When Richie and I started working together, this was challenging for him. It wasn't natural to not trade. But I knew that in order to break that, he had to force himself, or I had to help force him to do what wasn't natural, because what he was doing naturally wasn't working. So you have to force yourself to build a good, positive, like I said, cycle. And part of that is understanding that discipline is a very, very big part of it. And discipline just is not about how much you are willing to lose. I, myself, me personally, was very undisciplined early in my career. And it was because when I started my career, you didn't really need a lot of discipline because they were handing out money like it was, growing on trees. But then eventually the money stopped growing on the trees, and most of us, some of us, didn't have the core foundation of discipline intact because we never really understood it and we didn't need to. I was a product of an environment. And when the environment changed, I realized that I didn't have the principles to see my way through. Maybe I could last another year. Maybe. But I got smart and I realized that trading is a business, and it's not a business of quantity. It's not about how much you trade, but it's a business of quality. It's about the type of trades you take and your patience and your discipline and your thought process. That is how you find success in this business. Ultimately, and the fifth part of this is conviction. You don't hesitate or second guess yourself. Why? Because you have conviction. How do you get conviction? You get conviction by practicing. Richie has great conviction in his trades now because he's seen these events before. It's not new to him. He's spent the time. He's spent the hours. He's gone through the material, I don't even know, 150 times.
151 last.
151?
Yes.
That's not enough.
Okay.
Get to 200 and talk to me. He's gone through the material enough that he knows it like it's his right hand. So when he sees the trades, he immediately has the conviction. The natural occurrence for a trader is to second guess. Well, I like this trade, but I'm not really sure, so let me wait and see what happens. Sorry, you've lost your opportunity. You've missed your window. The market will not wait for you, and you wind up chasing price. And when you chase price, it means you've increased your risk. It's not the same probability anymore. You should have bought it yesterday, 2 days ago, an hour ago, but now you're buying it because it's already making new highs. You should have bought it on the pullback, and we're going to get into this. You've missed it because instead now, while the trade still may go higher or lower relative to whatever the trade is, instead of your risk being 50 cents or $1 or $2, your risk is now substantially larger. It's not the same scenario that it once was. Conviction is everything. And the way you get conviction, and it's not just for trading, it's to be great at anything, whether it's basketball or sports or any business. You got to believe in your ability. And in order to believe in your ability, you have to practice, and you have to know what you're good at. So it is a cycle that builds over time. So what's the book? By Malcolm Gladwell. It was like a New York Times bestseller. I think it was The Outliers. And the book basically was, why was Bill Gates Bill Gates? And why was Michael Jordan Michael Jordan? Why were these people, so above and beyond what everybody else was? And the reality of it is that when they studied them, they practiced. And they practiced and they practiced. And they had 10,000 hours plus of practice. Now, I'm not saying you need 10,000 hours to be a great trader or a good trader or a successful trader, but you need to practice. And you need to know what you're good at. You need to have a good foundation. You need to build it. These are the important parts of trading. It's not just, where's the moving average or where to buy or where to sell. That stuff will come with time the more you practice, practice, practice. Strategy. So we're going to talk a little bit now. I'm going to pass it over back to Rich, and he's going to go through some of the technicals with you. When you participate in the Active Trader course, and then following the course, we do what's called mentoring, so that now you've gone through the literature. You now work with Richie in a private forum, real-time, intraday, trading together. Evaluating trades. You get to see what he trades. And he will help you, figure out what you're doing right, what you're doing wrong. It's a very, very interactive experience. What we focus on, really, just a couple of strategies. And what we've done is we've outlined just, I think, one or two here that he's going to go through that he looks at, I don't know, almost every day. And he's making a living by doing these basic concepts. So I'm gonna pass it over to him, and I'm gonna let him take it from here, and I will rejoin shortly thereafter.
Okay, thanks, Laz. Is my screen share okay? Is it? Okay. No, not yet. That's showing this. Okay. All right. Well, thank you. So this slide, thank you, Laz. So this slide, we talk about the setups and the strategies from the Active Trader Room. Now, I like the term bread and butter because this is your lifeline. This is the tool that you need to be green and be profitable and make money in the markets. When I first started out, as I will say time and time again, I had no setup. I had no plan. I didn't know what worked. I couldn't tell you why one trade worked and one didn't. I didn't have a repeatable, profitable pattern or strategy to trade day in and day out. And it's an unfortunate thing because most new traders never really give a strategy a chance or learn enough to really have a fair shot at making money in the markets. And I myself was going down that road, until I made the adjustments and I began to learn what did I need to do to make money. I had to plan my trade out beforehand and then trade the plan. Normally with my setups, and I'll just go to the next slide here, I ask basically three things. Is this my setup? And then where's my stop? And then where's my target? So if you can't explain or talk yourself through that trade, or if you had to write a friend an email and tell them why you were buying Apple today, if you couldn't come up with 2-3 lines of why you were buying Apple, then you definitely need help. And I myself was that trader. I did make the adjustments. I had to read over the material. I had to watch the videos countless times, more than I would like to even admit on here, because I think 151 was even spot on. It may have been closer to 200 or 300. But if you don't do this, all of your results will be random. Your career will get cut short. And the chance to succeed in trading is greatly boosted if you take the time to learn. Now, there are no guarantees, but if you take the time to learn, you will enhance your chances of being profitable in the market in the long run. So these two setups that I'm going to mention, first is the moving average buy setup. In the room, there are probably 5-6 strategies that we teach. These are the two that I gravitate towards, and I think you'll only have to be really proficient in one or two to make a living and constantly take money and out of the market and know your risk and do well, master one or two. So the moving average buy setup, and all these setups can be longs or shorts. They can be swing or day trades. The only thing that changes is the time frame. The moving average buy setup is a trade within a trend, so it's trend following. If you see my mouse here, you want to find the trend, whether it's a daily or 5-minute chart, that's in motion. Now, instead of buying at highs, as many new traders do, you want to sit back and let the trade come to you. You want to buy it at a location that makes sense where you can define your risk. Because if you can't define your risk, you're really not doing much for anything. Then you're just gambling, and not even gambling well. You want to buy into a location, and that's we have our 8 and 21 EMA. The trend is in motion, and you want to see some type of shallow pullback, preferably 38% or 50% of the initial impulsive move up. You want to buy into a location so you're not just chasing highs. You have your risk defined. You could set a target, and you know your risk, which is the biggest thing that I can't stress enough, is knowing how much can I lose on this trade rather than how much can I make. The entry into the moving average or break of the prior bar high is covered here. You could get involved in the trade in 2 steps. You can buy half your position into the moving average and the other half once it starts to work. That's most of the times how I make my money intraday, and I do the same thing for swing trades. The intraday setups, the execution time frames, as we like to call them, are the 3, the 5, and the 13-minute charts. For the analytical, for swing trades, it'll be 30-minute, 60-minute, and the daily charts. These setups work across any time frame, whatever suits your personality or risk tolerance. They can be applicable to many different trades, long, short, day, or swing. Now, let me show you some examples that we've spoken about in the room very, very recently. This one is LVS. You can see a 3-minute chart here on my left. We have the initial pop off the open. So this should get your attention, and waiting for that setup to come, waiting for a base, waiting for the stock to pull back and rest. And once you gauge the reaction into the moving average, you can tell by how little we did retrace here that the bulls are still in control of the stock. So what are you doing? You're getting involved in a strategic place, defining your risk. And that's really all you could ask for. No one knows what's going to happen after you buy the stock. It could go up from 22 to 30. But what you know is that your risk is defined, and that's the only thing you really have in your favor when trading, knowing where's my risk, and your worst case is built in. On my right here, this is a 15-minute chart. It's the same principle, impulsive move up. You can see merely profit taking, does not look like fresh selling. As soon as we come into the general area of the 8 EMA, you can see the bars get really narrow, and then the bars step back up, and the stock continues upward. Here's just another example, multiple points right here. Impulsive move up. You can see the consistency of the strategy, of the tactic, and if you look at the strategy over and over again, you will become much, much better at it, and you will be able to pull more and more money out of the market the more you see the setup and you know it like the back of your hand, the way that I do, the way that Laz taught it to me, and the way I try to pass it along to the students in the room now. I have some examples now. These were trades from this last week, in fact. Here's a 3-minute look at Apple. Impulsive move off the open. See, once we came into the 3-minute 8 EMA, by a step back up, you have all these little bottoming tails in place. This is your risk, and my 3 arrows show the 3 different spots that you could have got involved or even moved your stop up, locking in gains as the trade continues to go in your favor. That would be an execution. That would be a day trade. Here's another one on Goldman Sachs. Impulsive move off the open. Kind of hard to predict this, kind of random. You wait for your spot to get involved. We have 3 bottoming tails, nice doji candle here. You can see we retraced probably 38% or less of the move. Bulls still in control, had some nice follow through. Here's a look at a swing trade now. Like I said, this works on 3-minute, it can work on a daily, it can work on a weekly. This was a trade that I was involved with after the huge gap up On earnings, that was your impulse. Kind of hard to predict that, but what you can predict is you can gauge the pullback and the spot to get involved. We were buying LinkedIn on Friday around 233, 234 against the 8 EMA. You see we had very nice follow through. We exited out most of the position north of 240, 242. So we missed the earnings move. Kind of hard to predict that. We're not going to be taking things into earnings, but what we can do is the thinking man's trade. Wait for the stock to calm down and see what moving average is in control. And that's what we do day in and day out in the room. Here's another example of very, very similar setup. Here's look at Baidu, had a nice earnings beat. The stock held up very, very nicely, and as soon as we came into the general area of the 8 EMA, it doesn't always hold up, but once you start to see these narrow range candles and these bottoming tails, this is your signal that the buyers are stepping up here. You have to see the reaction at the moving average. So I would say the moving average setup is probably where I make primarily most of my money. A close second would be the catch play long. The only difference of the catch play long is that the stock, if you want to read along, the stock is caught underneath the moving averages. So the stock really wouldn't gather any attention from me. The stock is running below the 8 and 21 EMA. Really doesn't make sense to be involved with it until something changes, and the chart tells you that. So it's very hard to predict and make money on the first move if we pop back up above the moving averages, but if we start to pull back and catch on the moving averages, that's when something changes. Why? Because you have a pivot and you have your risk, and you know how much can I lose on this trade. It's all laid out in front of you. So just to read along, it's a downtrending stock that closes above the 8 and 21, and then once you get that pivot, that area where you could define your risk, that's when you know it pops up back above the moving averages, pulls back, catches, that's your spot to get involved with it. Now, if we go to a real-life example, well, here's an example of the catch play. This is from the book. You see the stock is running below the 8 and 21 for quite a while, and then right about down here, this move happens. Now, to me, this move, you really can't catch that, or that's trying to catch a falling knife, trying to catch a bottom, which doesn't work all that well in the markets. What you can catch is the catch play. Sorry to use the word catch 7 times in the last 30 seconds. But the catch play makes sense right here because you have your risk. You know what's the worst case, how much can I lose, and you can plan around that. You could plan how many shares should I buy, and then you set your target. But to me, the stock has no reason to be in it, has no reason, then right about here something changes. Now, it's still in wait-and-see mode, but once we come down here and we see the buyers react and buy off of the 8 EMA, that's your signal that something changed, and you have a low-risk opportunity to get long the stock, which wasn't a good long for quite a while, but now something changed. Here's a few other charts we have very, very similar. Stock was under pressure, finally pops back up above the 8 and 21, gives you that low-risk pivot to get involved with. This is a 5-minute chart. This works well with daily charts. I'll show you a daily chart that we were talking about in the room this past week. That worked like a charm. And the 13-minute, 5-minute, the day trades work just as well too. Same thing here with Visa. Below the EMAs, below, below, below. We finally pop back up above it. Catch on the moving average, and your risk is defined. So it's the type of setup where the EMA buy setup is more of a trend following. The trend is in place. I would categorize the catch play as being more of the start of a possible new trend. How long that trend will last, no one really knows for sure, but what you know is that now you're not just catching a bottom, you're thinking a trade through, it makes sense, and you know where your risk is, and you know where the stock shouldn't go and when you're wrong to get out. So you can get in front of very powerful trades that can be very difficult to catch. Here's a look at BlackBerry, which is one of the worst stocks in the market. You couldn't get me to get long this one if I had Lazarus money or anyone's money for that matter, a stranger's money.
Settle down over
Yeah, I mean, you cannot get me to buy this stock. So right down here, you can see something begins to change. What do? We pop up above. So that I would not lose sleep over missing that initial move. But what you can catch is once we begin to catch on the 8 EMA. So when you see this, you should be thinking something changed here. Now something is different. Now I have an out. Now I have the moving averages underneath a stock that was running below the EMAs for quite some time.
Hey, Rich, can I just jump in there for a second, if you don't mind? The difference here between the two strategies is, one, as Rich mentioned before, is that you have trend continuation, right, in the moving average buy setup. But in the catch play, again, these are, I would say this is a touch of a little bit more challenging or difficult trade for a lot of students, especially more on the novice side, because it is a reversal strategy. Notice in all the slides, whether they're intraday or daily stocks, and again the one you're looking at in BlackBerry, you have a stock that is in a severe downtrend, where you have money outflow. If you look from June all the way through into August, the price goes from 15 to $8 or $9, and then you get that catch play, and it tends to be, depending on the time frame. Again, this is a daily chart, a very sharp, fast reversal. Notice the outcome after the catch. So you get the pop above the moving averages, the very controlled pullback into what is now a rising 8, where that little arrow is, and then notice the pretty substantial reversal that follows. So when you find catch plays, generally the consensus is that they're short-lived. They tend to be a little bit more short-lived as they are reversals, but when they do happen, they can be very, very short-term, powerful reversal strategies. So I just want to add that little bit of, add that 2 cents in there.
Yeah, listen, if you look at the size of that bar too, you probably had maybe 15 to 20 cents of risk on this BlackBerry trade. But like I said, these two are the primary setups that I gravitate towards. We talk about this all day. Normally a sample day in the active trader room, we start up at 8:30. We do some game planning session. I'll give 4 or 5 of my top ideas that are based primarily off the daily and hourly charts. The 5-minute charts are a little too fickle to game plan off of, so we have a morning meeting. I do encourage everyone in the room. They do submit 4 or 5 names. There's a lot of times where we'll bring up the same names, which is a sign that we're both seeing it and feel even better about the possibility of the trade setting up. We do that at 8:30. Then I'm on air the first hour and a half of the trading day. Once a week we do a Q&A, and also we do a lesson that I will get the topic from the group chat in general. I'll ask, what do you guys want to talk about on Wednesday? So that way I can address individual needs, whether you want to talk about stops, moving averages, anything that I could do to shorten up the learning curve. I try to address those individual needs once a week. We have 1 hour. We have the educational topic, and then the Q&A also once a week. So it's always an environment of continuing to learn and also continuing to get better and helping each other out in the room, because everyone has the same goal in mind.
All right, Rich, you want to maybe hand it back over to me?
Yeah, let me hand it back over to you.
All right, let's see. I don't think that's the right screen. There we go. Let me just make sure we are in the right spot here. All right, so let me just move forward here into, okay, so I want to thank everybody for attending tonight. Trading has been, like I said, a labor of love, and tonight's webinar for me in particular, very, very meaningful, only because, I've stepped away from trading for a little bit. I am, now CEO of T3 Live, but I really, I want to just congratulate Rich, because he's done an amazing job as a student, and I think that, when you set goals and you talk about setting goals for yourself as a trader, the first thing that I always recommend for anybody is the best goal you can give yourself is to become a master of something, to be an educator. Because if you can educate somebody else to do something, it means you've mastered your domain, whether it's in trading or in anything. Education for any trader should be a goal. It's a selfish goal. I know that when I trade or when I educated, a lot of the things I did only reinforced what I should have done or should be doing as a trader. And you know, Rich has really embraced the education side of it. He's very good at it. He can relate to pretty much every trader because, you know, look, nobody starts out at anything good or even great. It takes work, and he was probably 1.5, you know, feet out the door looking for something else to do because he just wasn't getting results for his time. He was spending lots of time, you know, spinning in circles. And we were able to acknowledge the problems, rectify the problems, and now he can, you know, essentially teach others how to do the same. And that to me is a goal that you know, is a real sign of being great at something. So with that, you know, I want to thank you again, and I hope to, you know, see you in the active trader room. Please, if you know, don't hesitate to reach out to me directly. You can see my email address, evan@T3Live. I'm happy to always answer questions or have dialogue with anybody, you know, as best I can. And I'm going to, at this point, do some Q&A. So let's see. Question here for Rich from Ashram. Rich, what risk management do you employ?
What risk management do I employ? Well, whenever I get into a trade, you know, I know what my stop is. So depending on how I feel about the trade, is it an A+ setup? Is it a B+ setup? Is it something that I've been game planning for a long time? Or is it something that I'm taking from the room? That will depend on what my share size is. But most times when I do take a trade, you know, I'm not risking all that much for a day trade. It may be less than 1%. It may be $1. You know, it might be $1 on something like, you know, something like an Apple. Like, it could be very less. It all depends on the size of the candle that I'm trading against, how I feel about the trade, and most times I do employ a hard stop versus the pivot that I'm watching, whether it's a nickel or a dime. That also will depend on the price of the stock.
In the slide here that I have up on the screen, you can see in all the strategies that are taught in the active trader room, part of the requirement of the strategy is understanding where the stop is. So when we talk about risk management, you know, we always know, Rich knows, you know, where he's a buyer, why he's a buyer, where he is going to get out of the trade if he is wrong, why that level is the level. So stops are the most important part of what we do outside of the actual, you know, trade itself. It's understanding the strategy, and in every strategy, the stop scenario is, you know, basically baked into the strategy. So it's a monumental part of what we do and you know, how we do it. Question here. After the setup works, how do you know, or what setups do you look like for, or what do setups look like for exits? Let me read that one more time. Rich, after the setup works, how do you know, or what do setups look like for exits? So I think the question really is once you're in a trade that is working for you, how do you know where to exit the trade?
Well, we have various trail stop methods that we employ in the room. Sometimes we'll use the moving average that got us into the trade. So just for bringing up a decent example, if I buy off the 8 EMA on the 5-minute chart, I will stick with that trade until that 8 EMA breaks. Now, there will be points along the way where I will sell some of my trade, maybe at new highs, maybe at the 618 extension or the 100% fib extension, which is also more things that we employ in the room. But most times, you know, we will look left, we will look for a prior high, a prior pivot, and trail along the way, either using a new pivot on the same time frame that we got involved with. So if we buy on a 5-minute, we'll wait for a new pivot on the 5-minute, or use the moving average that got us into the trade to begin with, trail it up that way, and try to stick with the trade.
You know, we'll also use things like fib extensions, some crafty little tools that Rich and I have become very reliant on to determine price movement or potential price movement. We'll use, measured moves. We'll use prior resistance levels. It's all relative to the type of trade that we that we take. But there are, basically 3 or 4 methodologies for exiting a trade.
Yes.
Question here from Steve. On something like Baidu and LinkedIn swing trades, where do you place a target, or do you continue trailing until it breaks the 8 EMA, which kind of rehashes what we just went over, but if you want to kind of touch on those two.
Well, yeah, trades. Most times, and with Baidu and the LinkedIn trades, I was using the most recent high for a place to take off some of my position. I was looking at, they built a range, Baidu and LinkedIn. They actually broke above the high. I sold into the high, but then unfortunately they did come back into the range and they broke my pivot that we broke out above. So I do sell into recent highs. I will just like I tier into a position, I will tier out. So I did sell into highs, and then the rest of my position I did hold until we did break. If you look at the chart on your end, once Baidu failed below 140. I did exit that position, and with LinkedIn, it was a similar type thing. We went up there and kind of failed, and I think around 238, 239, I got out of what I had left. So there was green trades. I did leave on a little bit more. I did leave on a few shares a little longer to catch a bigger move, but I was stopped out of a third of my position on both of them when they began to fail, and they wind up being pretty good outs. The market action is, today is a little funky for the longs.
All right, question here from Natalia. So how do you determine the set of stocks to watch? So, Rich, where do you, and again, I'm throwing all these questions to Rich because as the former teacher to the student, now he is the teacher, I'm going to make sure he answers them effectively. So by doing this, I'm testing Rich.
Oh, boy, here we go. I've been down this road before too many times.
How do you determine, Rich?
Yeah.
What stocks you're watching?
I like
and
to
why,
look
Rich?
for this.
Why?
Okay, why? Oh boy, he had thrown the why. It's his favorite word. I like to look at the 8 and 21 on the daily chart, and I like to look for slope. I like to look for, if I'm looking for something long, I want to see a steep slope. So I want to see the 8 and 21. They should be riding on top of each other with some slope, with some pace, something that's in a confirmed uptrend. Why? Because those dips, they will be more viable than something that's flat and range bound, and you have a better chance for follow through on the names that are sloping up above the 8 EMA with rising 8 and 21 moving averages. Flat range bound EMAs lead to a lot of random price action and not much follow through. So I like to focus on the names that are in play, and I tell that, and I see that by the moving averages. In fact, a good tool, and Lazarus we do this all the time, was take the price candles off the chart and just look at the moving averages and is there slope there? If there's not, maybe you should scratch it and go to the next chart. But I do like to look for the names that are sloping up, and I do like the names that move around. I like the Teslas of the world, the Facebooks of the world, the names that are in motion. They're more likely to stay in motion, and I try to jump on at a location where my risk is defined.
All right, here's a good question. This one's from Lizzie.
I'm scared.
So, Rich, do you wear whites after Labor Day, and how do you stay so fit?
I don't wear white after Labor Day, and the fitness sort of went downhill after I got married about 10 months ago. Now, at the bachelor party, now that was fitness. Now, falling off the wagon, I got to get back on the wagon, but I'll try to get there.
You are slipping.
Yeah.
Question from Vishal, how much of a difference in using the EMAs versus the SMAs? I'll take this one. EMAs, again, and SMAs, it's kind of it's not that there's a better or a worse. There's no better or worse. We focus solely on EMAs because the way EMAs are calculated, obviously a moving average is an average price over time, but which is what an SMA is. It's a simple moving average. So it basically takes, an average, like I said, price over a certain amount of time. The EMA is an average price over a certain amount of time. However, it calculates current price and weights it more heavily than historical price. So the reason that we've gravitated towards EMAs is because as active traders, I am much more concerned with what is happening now and the impact of current price rather than historical price. So for us as active traders, I've just found a lot more success working in the EMA world and staying consistent with EMAs because I like the fact that it calculates current price more heavily than historical price. So it provides a little bit of edge for us. And again, it's like I said, it's not a better or worse. It's just a preference. And the preference is because, like I said, we're concerned more with what's happening now. Okay, so maybe one or two more. Question from Gavin. Rich, are your trades listed in real time on the virtual trading floor? Question mark.
Yes, the trades are listed in real time, but only in the active trader room do you get the commentary and the one-on-one attention versus the main room. You know, I will talk over a trade. People ask me all the time, Rich, how come you're in this? You're out? We throw back and forth. Rich, I'm thinking about buying Apple right here. Does it make sense? And I'll answer very bluntly, yes or no. Well, yes, it makes sense versus X, Y, Z. Or so my trades are on the virtual trading floor. You know, there's swing trades, there's day trades. I do a mix of both, from 5-minute charts to 1 to 3 day chart trades. But in the room, actually, that's where the commentary occurs, and we go back and forth pretty much all day in the room, throwing back ideas.
All right, good stuff. Last question here. Let's see. Hold on. I just lost my spot. So the setups. Do you use these setups and strategies on all time frames, or are they just intraday or daily or both?
I use them on both. So the same look that I want to find on the 5-minute chart at 10:30 after an initial pop off the open, I like to look for the same thing on the daily chart, whether it's a bull flag or just a nice corrective pullback to a rising 8 on the daily. That would be a swing trade. So a 30-minute, a 60-minute, or a daily is for swing trades. Those are the analytical time frames that we teach in the room. Intraday, early part of the day, you know, we're looking at 2, 3, and 5-minute charts. Gradually begin to look at the 13-minute chart. As the day goes on, slope will begin to decrease. So there's volume. So the setups really could work on any time frame from intraday to daily to even a weekly. That just depends on what your risk tolerance is, what your personality is. I know some people don't like the hectic action of 3-minute charts. Some people are better wired for swing trading. So, but the main thing is that the setups do work across all time frames. So yeah, both.
The only thing that changes about the strategies or the setups is the risk. So if you're taking, and I think we actually had a couple of highlighted examples there in the presentation. I think Rich showed a 3-minute chart.
Yeah, it was Goldman Sachs and Apple, those trades with 3-minute.
Right. Where is it? I'm going to bring it up right here. All right, so there's the 3-minute Apple chart. And this is an example of a trade that he took off of a 3-minute chart, which, again, is an execution time frame, was a moving average buy setup. And it's meant because he takes it on a 3-minute. He knows that it is only going to be a day trade. It will not become something more than that. So the strategy is quite simple. You take the trade off of the time frame, and if the trade is a day trade off of a 3-minute chart, he will be flat that trade by, you know, either the end of the day or at some predetermined target, assuming, you know, the stock, you know, follows through on the strategy. So swing trades, whether it's a swing trade off of a daily chart or a day trade off of a 3 or a 5-minute chart, the idea is that the risk is built into the trade, and he knows exactly where he's going to enter and the type of trade it's going to be relative to the time frame. So I hope that's a good answer to that question. All right, I think that's it. I am going to now turn it back over to my colleague, Mr. Michael Milani, who is going to wrap it up.
Thanks, Les. Yeah, again, just want to thank you and Rich for a great webinar tonight. I know a lot of good questions there from the crowd, and I know a lot of people got a lot out of it, at least from the emails we're seeing already. Before you guys go, if you enjoyed the content of the webinar and are interested in taking the Active Trader course with us and Rich's mentoring class, which a lot of people are getting a lot out of, normally the retail value for the Active Trader course and a month of mentoring is around $2,300. But for everyone that's signed up for the webinar, if you'd like to be involved with that, we can give you both of them for $897 for the next week or so. So, like, again, Active Trader course, 1 month of mentoring, $897. If you're interested, email info@t3live.com.